3 stocks way off their 52-week high. And guess what, guys? I own all 3. Again, don't buy a stock just because somebody on the internet says it. And I'm really, really hoping the stock goes down. I fully expect all 3 of these to go down, and I want to buy more as they go down. Stock number 1, Target. Guys, Target is now at 137. It hit a low of 101 on October 6th, Mo. 52-week high was 176. All-time high was a mere 2 years ago at $254 per share. I look at this when it was selling for 105, and I dollar cost it average down. I started at 135 and just started buying down. My lowest purchase was 105, so I didn't get the bottom. Hopefully it's not the bottom.
Yeah.
Hopefully it's not the bottom. I want to repeat that, guys. It's funny. Somebody on Twitter the other day wrote and said, well, Paul's missed a lot. I'm like, what have I missed? I'm like, have I missed not buying FOMO? Absolutely. But I look at it going, it should not be looked at and miss as when a stock that you want falls. You're missing it completely if you think that you're going to have results in the next month or two. Just like when people in our community tell me, Paul, I applied your process in the last 2 months. I'm up this. I'm like, well, yeah, the market's up a ton in the last 2 months, and judge your performance over 5 or 10 years. That's hard to do. But that's what we're trying to teach here, is that process of looking at a business as a future stream of cash flow. With Target, I don't think they're going away. Mo, do you think they're going away?
No, they're not going anywhere.
I don't think so either.
That would be a lot of bad things would happen out there if that went away.
I would be absolutely floored if in the next 20 years Target was gone.
Yeah.
I'd be like, whoa, what happened? Yeah. Doesn't mean it's not likely. Could.
Sears went away.
And Sears was the leader back in the 70s and 80s. Absolute leader. So who knows? But right now, they pay a $2 billion dividend, which a lot of people like. I don't. I wish they'd been buying back shares with that $2 billion.
It's a big chunk of their free cash flow.
Yeah, it is a big chunk. But you know what? You look at it going, what else are they doing with their money? Sure. Again, stop that dividend.
Yeah.
That's a very unpopular opinion, but don't pay a dividend. I don't want the dividend. Hope for the stock to go down, buy back the shares. If the company thinks the stock is cheap, buy back your shares. Now, is it screamingly cheap? No. But at the end of the day, it's like, what's going on here? Mm-hmm. Buy back your shares. Look at their 1-year profit margin, down significantly from their 5-year average. 3.4 versus 4.3. So I look at this saying, okay, maybe their stock really is a 13 or 14 price of free cash flow. Guys, buy back your shares. Buy back your shares. Okay, let me do let's look at the stock analyzer tool and see what values I came up with back in September. Yeah, I made some assumptions here. 2.5%, 4%, and 5.5% revenue growth. Profit margin 3.25 up to 4.75. PE, I think my PE is light. I did 15, 17.5, and 20. And my desired return of 10, 12, and 14. So it's basically at the middle number here. And like I said, I was buying sub 135. Okay. So I look at this going, low side 103. That's how good of a screaming deal it was. Yeah. Stock number 2, Disney. Again, I also own Disney. And it has same thesis I have for Disney as I have for Southwest. Their profit margin is 2.6% in the last year. Let's go to before COVID and see how the profit margin was.
Like 9 to 12, somewhere in there.
Let's see here. 70 billion in revenue, 11 billion in profit. So that's 12 or 13%. Mm-hmm. 60 billion in revenue, 12 billion in profit, 20%. 55 billion in revenue, 9 billion in profit, 15 and 16%. So the whole point is, my premise is, even if they just get back to 10% profit margin, which would be still low for them on this record revenue, you sit there and go, they're going to 5x their profit, their free cash flow, everything. I look at it going, you're buying a cheap company there, and that, in my opinion, a great brand. I mean, Mo, look at this, $172 billion market cap. Yeah. I'm going to ask you the question, if I gave you $172 billion today, could you compete with Disney?
No.
Probably not. That to me is a good brand.
Not easily.
Not easily. Even with $172 billion. So let me go here and let me go to a stock analyzer tool. Go to Disney. I did it back on September 19th. So I still went low on profit margin, but I had 2.5%, 5.5%, and 8.5% revenue growth. Profit margin 6, 12, 18. Same with free cash flow. PE 17, 20, 23. And here are my returns. 10, 12.5, and 15% returns I want on my money. And hit the analyze button. There you go. I'm going to add it back to my watch list at $90 to buy more shares sub 90. It's at $93. Hopefully I can buy more shares. It's a very wide range because we have a very wide range of profit.
Yeah.
We have a low of 43, a high of 170.
Got to figure out where the profit margin is going to settle out.
Correct. And if 12 seems like a reasonable profit margin, they were 10, 11, 12, 15. Okay, so a long-term average of 12 makes sense, but I also put in a really high return here. Really high returns. That means the stock is worth way more. If I buy it at today's price and the middle assumptions occur, I can expect about a 13.5% return. That includes a dividend, guys. So before we get into the Paycom numbers really quick, you guys, we have this great software with all these tools. You haven't even seen all the tools here. The community, thousands of investors talking daily. Free 7-day free trial, everythingmoney.com, full access. Go check it out. Go learn about it. Final stock number 3, Paycom. Talk about lucky here. I got super lucky on Paycom. One day it collapsed. It's below 150. It was on November 2nd.
Earnings day or something?
Something like that. I bought it for 150. It went to 145. And I was like, this is going to be juicy. It's going to keep falling.
Skyrocket.
Guys, I want you to hear something here. It's at 208 right now, and I am beyond disappointed. That's the mentality I want everybody to have. That you get upset that a stock you bought is up 40%, 35%. That's not what you want. That is not what you want. You want the stock to fall. If it's a good company, and remember, this is a payroll company. Look at their all-time high, Mo. 556 just 2 years ago. The exact 1 year, oh my God, look at that, Mo. Exact 2-year anniversary. Had their 52-week low and all-time high.
Wow.
52-week high, 372. It got to 145. That's how much things can change from emotion. How does stock go from 180 to 145 in basically one day and then back up to 208 in 6 weeks? Does that make sense? That's what we're here to teach, guys. It's on my watch list. Let's go to our stock analyzer tool and see how I got to my purchase price. October 31st. Days before the collapse happened. I did a 20-year analysis. I didn't do 10 years, Mo. I did 20-year.
All right.
6, 10, and 14%. Profit margin, 18, 20, 22. I did a little bit lower in free cash flow, because as you can see here.
Historically lower.
Yep. And for PE, I put 17, 20, 23. And I put a higher return here, 11, 12.5, and 14.
All right.
All right. It's at 208. And I had it right here. That's why I had my strike price at 150.
Nice.
So you can make it pretty decent. This says you make 9.6% if you bought it at today's price and the middle assumptions occur.
Nice.
Guys, thank you very much for your time.